I just saying my thoughts go out to those impacted by the tragic earthquake in Turkey and Syria. We've had so many problems in the world the last couple of years, and so much heartache and tragedy that it just continues. So it's amazing how much has been thrown on people over that period of time. And the economic challenge is not going to get any easier either. So I just want to jump into that and talk about where we are and where we're going, and why this tug-of-war is going on between recession or hard landing, soft landing, or where we're at. So let me just start with a year ago, we were in a very different scenario, and today's economic strength that we've had in the markets is really a reflection of the easy money conditions that have been put in place over the last several years to deal with the pandemic and with the war. And just to put it in perspective for you, a year ago, Fed funds were near zero, and we were doing about $125 billion a month in quantitative easing in the US. Today, Fed funds is at 4.75%, and we're doing quantitative tightening to the tune of around $95 billion a month. So very significant change there. M2 growth was up 11% year over year 1 year ago today. Today, it's now down 2%. Unemployment was at 4% in January of 22. Now it's at 3.34%. So there's a question now, is it possible that we have no landing, not a soft or hard landing, but we continue to kind of get low economic activity pushing us through. And I think that's part of the challenge for investors. And what we're looking at in the markets today is this battle between the central banks saying that we need to have rates high enough to stop inflation, and the market calling for 2 Fed cuts in the second half of the year. There's a disconnect there, and we believe that the Fed is really focused on the right issues, and we'll talk about them in a second. But we think this disconnect is really where the opportunity is going to be created. We've gotten out of the blocks extremely well this year from a market perspective, but there are challenges throughout. So let's go through some of the issues. Unemployment surprised, the report surprised to the downside in terms of the number, but a lot more people came back into the workforce. This is the lowest level we've had in unemployment since 1966 at 3.4%. That is not the sign of an economy that's about to go into recession. And this is one of the dilemmas that's creating this higher wage pressures, higher issues around employment and labor against other areas where the economy is showing softness and return to more normal pricing in many areas. So I think the unemployment issue is a big one. And then you look at the jump up we had in the jolts of 500,000 people. Now we're over 11.012 million people unemployed, with about 5,000 people looking for jobs. So you have actually a very interesting dynamic in the number of unemployed persons per job opening is at a record low for some period of time as well. So these tight labor market conditions and distortions in the labor market from the hiring and firing of the pandemic and related rolling of recessions that we've had has created these distortions in the economy around unemployment, around a lot of the pricing that's in the market. And we're working through those distortions, and it's creating problems for the market and the policymakers to get aligned, mainly because nobody really knows what the outcome is going to be, because we've never had this type of shift in the global economy at the same time that we're doing massive quantitative tightening on top so soon to a period where we had the greatest period of quantitative easing and fiscal support for the global economy in history at over 50% over the last 2 years of GDP. So you can see where the challenges lie, and we have a very tight labor market, which is part of the concern that we have had some easing in inflationary issues, and the Fed has highlighted that we see some signs of disinflation, but we also are seeing the economy rebound, and the view of the market is that the Fed's closer to peak rates and is starting to ease. And you saw that with the rebound in the stock markets year to date. You saw that with bond rates, bond yields coming down. Now we had a pretty sharp jump up today. Chair Powell is speaking in an hour at the Economics Club of DC. The interesting thing will be is he was viewed as a little bit dovish last time because he led with disinflation. I think the market's going to find that he hasn't really shifted his views at all, and that he's been pretty much acknowledging that things are getting better in some areas, but the labor market problem is one that they're going to be focused on for some time, and they don't think we're out of the woods yet. And there are some real issues down the pike that they have to keep an eye on. There's Russia's building up for an advance that could happen on the 1-year anniversary. They could be leading up to that. Remember, the window for a lot of action will be while the ground's frozen before the thaw. So that still is an issue that they have to keep an eye on, but we're worried about a pickup in that. We've had the benefit of low energy prices. That could turn pretty quickly if the weather changes much. So there are a lot of issues that are out there that are creating distortions that are issues that are coming that we have to deal with. The China reopening has been a big boost for the global economy, but will it hold, and can they keep that going? Does the balloon flying over the US and the canceled visit to China start to change the dynamics there? You have other tensions rising around the world. So there's a number of things to be concerned about. On a more positive note, though, since 1938, when January is positive, the market's up for the full year 86% of the time with a strong return of 16%. When it's negative, the market still gains 40 for the full year, 40% of the time, with a median return of minus 0.8%. When January is up, the prior year is negative in the first 5 days of the year, and it's the rule of the 1 of 5 days, is greater than 1.4%. Stocks gain 100% of the time with the median gain of 20%. So that would be nice if that plays out. That's the setup we have going into this year. I'm not suggesting that we're going to see that. I do think we're going to see more positive gains in some segments of the market, but I think this is a market to own stocks, not own the market. Where we're putting money today is still in the areas we've talked about, industrials and materials that are going to be critical in defense, productivity and infrastructure plays in the electrification. We think that the productivity boom that we lost over the last couple of years is about to start to pick up. We think that you will see some positive changes in that area. The energy transition is going to take longer, and you're seeing big numbers coming out of some of the fossil fuel companies. But in BP's case today, they're actually lowering the amount of spend that they had on renewables and increasing the amount of spend on fossil fuels to help with the transition. We still think the biotech plays are going to be very critical to where we see things moving forward. And then really the focus on balance sheets and quality dividends. This is, when I look back last year, Mark, at what the presentation was the first week of February last year, it was about the shift from the Fed to fundamentals. And then the war came in, and that actually lengthened that period of time out that we're making the shift. But I think that is the big change. We have to forget about the Fed pivot and Fed support. Central banks are going to have to be vigilant. Right now, they're worried about a reversal back to where they were previously. And in the early 70s, they eased too soon, and it created runaway inflation, and that's very much on the Fed's mind right now. So I think that's where they're looking at. I don't think there's a big negative scenario that is the core case for us, or a big positive scenario, but there are pockets of opportunity to make good money in this environment, but it will be a challenging year with a lot of volatility along the way. And I just want to leave you with one last issue that came up. I saw this at a event I was at, and it's an interesting story, particularly apropos of our conversations in Florida, Mark. And Putin, Biden, and Xi were arguing about who rules the world, the US, Russia, or China. Without resolving their dispute, they turned to Indian Prime Minister Modi and asked him, who runs the world? He replied, here's what I know. The CEO of Google's Indian, Microsoft CEO is Indian, Adobe CEO is Indian, The CEO of NetApp is Indian. MasterCard CEO is Indian. The CEO of DBS is Indian. The CEO of Novartis is Indian. Diageo CEO is Indian. The CEO of SanDisk is Indian. Hartman CEO is Indian. The CEO of Micron is Indian. The CEO of Palo Alto Networks is Indian. The CEO of Ricket Bensizer is Indian. IBM CEO is Indian.
What are you trying to say?
The Prime Minister of the UK is Indian. The Chancellor of Great Britain is Indian. The British Home Secretary is Indian. The Prime Minister of Ireland is Indian. And the Prime Minister of India is Indian. So
Is
who
it
rules
too
the
late to
world?
change our name, Stephen?
So who rules the world? I'm not sure, but there was a lot of interest in India at the event in Florida. And clearly they got something going on. It's a question of whether they can get through it all. But I just thought I'd share that because it was a fascinating view of all those places and very topical for our Florida event. So I'll stop there, Mark. Open up for discussion.
I'm just wondering, because you have an event, you're going to talk about China-Taiwan scenarios in 2 weeks. And if I can share my screen, it was a year ago that you
February 8th, we did
yeah,
the
I'm just gonna show everybody. Let's see here. Yeah. So if you can see this, these are all the briefings that Stephen did. I just scrolled back. It was the 5th. Well, the 15th, was it the 8th that you talked about it, or is it the 15th?
might have been the 8th. Well, the 8th was the one I think I just did. So it was the 15th. Of Putin with regards to NATO.
This was before it happened.
All the other options brings major sanctions and economic hardship into play.
There were 6 options. There's no way that he's invading, right? So at least you put the questions out there for us to think about before it manifests. And thank you. So in two weeks, everyone, it'll be the 150th in a row from Stephen Berg. All right, questions, comments on what Stephen had to share?
Somebody put a question mark on the Adani Group issues and the activist report and what that means.
Yes, they're Indian too.
Yes, they are.
I've been at their headquarters, or one of them in Delhi, I think it is. Anybody want to comment on that?
I have a comment.
Oh,
In terms of their background, they obviously originate from India, but most of them were born in the countries where they're now. So it would be same if we were saying that, you know, in America, different governors are Italian or Irish, or you know what I mean? So it just kind of echoed a little bit in my ears.
Yeah, it's actually reflective of the conversations we had in Florida, where there was a lot of talk about India becoming the next leading economy. And there was a big debate on the challenges of it. And I just thought it was interesting when I went to a dinner after that event and somebody brought this up and was talking about who rules the world. And they had all these Indian CEOs. The question is, why are they leading American companies so well? And why aren't there more Indian companies doing better? I think that would be a fair question to ask on this.
well, we had 2 India discussions in Florida, and I'll just show. 1 second.
Stephen, while he's looking for that.
Thanks everyone for being here. I'm going to give you a quick overview of where emerging markets are.
So I'll pause it. I'll put it in the chat. Go, carry on. There's a question?
Joe?
Yeah, I see a lot of work, and I've studied the influence of demographics on the stock market, and our demographics are tipping over where the baby boomers aren't working; they're retiring. And I wonder if you guys have done any work on the demographics and to what degree this employment issue and this chronically low unemployment for the Feds to do anything aggressive on monetary policy is might be the issue. That we've got a lot of people leaving the workforce due to just the sheer numbers of baby boomers retiring.
Yeah, we have a demographic cliff that is bad. It's not as bad as India and Japan, China, and not India, China and Japan and Europe. But all the developed world needs to completely adjust their immigration policies. And they need to get much more aggressive in the US if we want to succeed. We need to get back to what got us the growth that we had throughout our history. When we needed to grow, we had more immigrants come in. They did the jobs that the people who were previously doing those jobs moved up the value chain were doing, and we have to get back to that. So we need help in two areas of the market. We need help in a lot of the jobs that people here don't want to do anymore because they feel they've moved up the value chain, but we also need skilled labor back in very particular areas. And one of the areas, ironically, is the carve out of the manufacturing sector over the last 20 years means we need to get more tool and die makers in. We need to get the skills that manufacturers had in the past and their apprenticeship programs and the like. So it's an educational issue, it's an immigration policy issue, but we absolutely have to do them in a major way. So I think the start for the U.S. is a complete shift in immigration, not from the illegal ones who are here, but closing the borders and opening up our country to bring in very strong quality immigrants that want to pay taxes and do the jobs that need to be filled. We have a big problem in the healthcare area for skilled workers coming in that area. And there's plenty of opportunities, 11 million job openings scream that we need an immigration policy that's different than what we have. And it's really it's incumbent on us to get our politicians to focus on what matters, not the noise.
There's others that also suggest that might impact the stock prices, because the older you get, the less risk appetite and the more you're looking for more yield and cash flow and that sort of stuff.
Yeah, demographic aging is deflationary. So if you start with the deflationary aspects of it, then it flows all the way through to less spending. And they're sucking more out of the system in terms of services. So it does have a negative impact, which is why you got to get younger. And we have to get younger quickly. And it can happen quickly too. I think the number, Mark, we heard in Florida was that Naples dropped in age about 15 years in a 2 or 3 year period in average age, because of all the inflows. So you can shift the demographics of a nation quickly if you have the right policies and are targeted. And I've mentioned this before, but Canada, which is a very warm and friendly nation, has very tough immigration issues, but they are doing very well with it. And it's part of what's been their revival over the last 20 years is how well they've handled immigrants coming in. We could take a page from their book and do much better. And I think we have to get numbers that are far greater between moving towards 1 million people.
We need to do an immigration event, but Pam was raised from Joel.
Yeah, I just wanted to add on to that, Stephen. The other issue is the global fertility rate is dropping.
Yep.
And so, we talk about, and that means the population is going to be more aged. The other interesting scenario is that people who are being born now, more than 50%, around 50%, are likely to live beyond 100 years. So those later years in life, retirement is not, I'm going to wrap up at 65 and do this. We got to be thinking in terms of a century. What is my purpose going to be on this earth? And what kind of healthcare am I going to need? How is the system going to support me? And where is this going to bring us to in terms of an equitable future and a future where everyone can succeed?
Yeah, and Joel, you bring up some great points there. The other element is that now we're fighting in France, for example. Macron wants to raise the retirement age by 2 years. And it's essential for that country to make that switch to finance their retirements. So people are giving up. They want short-term gain, but they're not looking at the other end of it. And we have it in with Social Security and Medicare. We have big holes that we're going to have bills coming due, and we need a very different, a much more robust growth rate to do that. Not just here, but all the developed world has that problem, and we're going to have to deal with it very much more aggressively than we are right now. And for the U.S., we can get people here easily if we want to. We just don't have the policies to get them here.
I think demographics is really a missing piece from a lot of conversations. In the AI world, there's always this sort of reaction, oh, is this going to kill jobs? And if you look at the data and the demographics, especially as we move, decades from now, there's, whatever we do with the interest rates, it's not solving the labor shortage without significant levels of immigration, because there is a, population collapse in most advanced countries. And when we look at AI, we see this as a solution. It's not that it's going to take anyone's jobs, is that we just simply don't have the populations for businesses to survive much longer without some kind of artificial intelligence or augmenting the workforce.
Michael, your hand up, and then Anthony.
Yeah, Stephen, to your comments about Macron in France and the need to raise retirement age also here in the US. The problem is you're looking at it from a macro level to the individual, each individual impacted who goes, crap, they want me to work another 2 years when I've been betting on 65 or 62, whatever the date is, the time frame. They feel cheated, right? They were promised this and they're getting that. So
Yeah.
that's what we're seeing play out.
Yeah, the promise that the issue for that is that the promise that they have is not sustainable either. So that if the country can't pay their obligations, something has to adjust. I think there are ways to do it that phase it in so that the people who are about to retire don't get screwed as much as the people who haven't paid into the system have to work longer. That's really what's going to come down.
I take your point, Joel, and longevity is one of our topics in our impact event, but there are demographic implications. Anthony.
Yeah, well, there's an interesting point there on nominal value and real value in a high inflation cycle. No, Stephen, I'm coming back to you. We're looking at economically inactive people in the inflation figures, which often in the UK don't record in the inflation figures. I don't know if you got any comment on the economically inactive post the pandemic.
You mean the people who just haven't come back into the workforce, or
that's it? They've come out of the workforce. Obviously, some are coming back in the States from what you said earlier, but in the UK, we're not seeing that same sort of numbers. I'm just wondering about the economic inactive in the USA.
One of the issues that we're seeing is one of the harder areas to get people back is in the younger workers who have been out and just aren't coming back in. It's one thing to have the old people leave and not come back in. When you have the young people not coming back in, that is an area that's of growing concern. How do you get them back in? Because then that's where the scarring comes in that we've talked about in the past. Economic scarring, where you lose part of a generation.
Yeah,
so I do think that's one of the issues we have to worry about. And for those old enough to remember the early 80s in Ireland and parts of Europe, where we had that economic scarring, and it hurt the economies for some time. So I think that is something we have to be mindful of.
Okay,
Paul Linden.
Hey, Stephen, I want to go back to the India point. As you said, if India is ruling the world, what happens if Adani crashes? What if Parliament does go in?
Yeah,
I mean, they're so intertwined, and that's the scary part about it.
I think in India's case, they have a ways to go before they actually rule the world again. The question on India is always, can they meet their potential? And can they rise to their potential, and can they overcome the embedded challenges that they have of politics and corruption? They've made some big strides on the corruption issues. They've done some incredible things with their technologies and biometrics to help them root out some corruption, but they have a ways to go there. And they have some problems that they have to get through economically, but they have a growing workforce and they have a lot of positives going on with them. I wouldn't worry about them ruling the world just yet. There's a lot of people ahead of them still.
I also don't see them crushing. I'm not worried about the crushing thing, Paul, either. They've got many drivers. I wouldn't be.
Yeah. But Adani is so intertwined between supply chain to the ports to the produce. I mean, they have their tentacles in almost everything, as well as the prime minister.
Yeah. Well,
that's the concern, I guess.
Yeah, I think somebody else will step in and take advantage of their misfortune. Is
They
the way
will.
India works, I think.
And if you want to learn more, you'll see it's TBA. We've been trying to fit in an event in Mumbai. We'll get there. We had two great presentations on India, and even the woman from BlackRock, before they even spoke, was talking about how they're looking at India.
Yeah.
So they have a lot of tailwinds.
But I would look at it as a longer term opportunity too, not
Yeah.
short term.
True. All right, Bill.
Sure.
I've had the pleasure of being with Bill virtually in both Dubai and now London. We have a road show going on.
That's right. We're the official global globetrotters for sure.
Yeah.
So anyway, yeah, just on India really quick too. When I was at Morgan Creek, the sad reality is that we had very, very few investments in India that ever worked out. And Stephen, I think you characterized it so well in terms of can they live up to their potential? There's just a ton of stuff there. And then I'll put on my trustee of a pension of a defined benefit pension plan hat on and talk to the demographics thing. I'll tell you, the one thing that hasn't been talked about and has been present for such a long time is the risk transfer with the rise of defined contribution plans versus defined benefit plans. People just do not understand how much risk was ported over to the individual, and the stats on individual investing are horrible compared to institutions. And I think that if we're facing a much longer term lifespan for current generation and on, I honestly think that we're going to have to rethink the defined benefit plan. And if you think about the sophisticated investors who are controlling these large pools of money, you want to talk about efficient use and allocation of capital, so much better. There's an enormous virtuous circle that could happen, and not the least of which that people getting to later years in their life have the economic security to transition to some other aspect, which opens up great opportunities for younger folks, as opposed to, people saying, shoot, I got to work till I'm 75.
So Bill,